Good morning, ladies and gentlemen. Welcome to the Czech National Bank's meeting with analysts. At this quarterly meeting, we ordinarily present and discuss our new macroeconomic forecast and also the most recent decision of the Bank Board. Today, we are here with the Bank Board member Jan Procházka and the Executive Director of the Monetary Department, Petr Král.
Hello to everyone.
And also the Director of the Macroeconomic Forecasting Division of the Monetary Department, Karel Musil.
Good morning to everybody.
Let's begin with the presentation of the new macroeconomic forecast. And now I pass the floor to Petr Král.
Thank you for the floor. Good morning once again from my side, ladies and gentlemen. It is really my great pleasure and honor to be here again after some time to deliver a presentation on the CNB's new quarterly macroeconomic forecast. Let me start by highlighting the structure of my presentation. First, I will introduce the assumptions based on which the new forecast was prepared. After that, I will offer an in-depth insight into the macroeconomic story of the new forecast in both qualitative and quantitative dimensions. After that, I will provide you with a brief comparison of the new forecast with the previous one. And final part of my presentation will be dedicated to further scenarios we prepared to facilitate monetary policy considerations of the Bank Board. As for the external side, we assume that the euro area economy will recover this year, which will be driven by a somewhat better situation in the country of our major trading partner, which is Germany, German economy, which is currently facing, as you very well know, quite severe economic problems that are partly of a structural and partly of a cyclical pattern. But starting mid of this year, the German economy and other economies in our region will start to recover, and the euro area, in effective terms, will exhibit quite significant GDP growth. Let me just remind you of the fact that when switching our core projection model to the updated or facelifted version, we now the countries of our major trading partners, effective euro area, is now proxied by 6 countries, namely Germany, Slovakia, France, Italy, Spain, and Austria, instead of previously used full set of euro area countries. As for price developments in the euro area, we can expect that PPI growth in year-on-year terms will stay in a negative territory, driven primarily by energy component, but also core component of that is currently very subdued following the very low domestic demand in the euro area, foreign demand, and by the restrictive stance of the ECB's monetary policy. When speaking about the ECB's policy, the current market outlook, which has been incorporated into the new forecast of the Czech National Bank, expects that the ECB will start its cutting cycle when it comes to the interest rates during spring, and will deliver further cuts throughout this year. Simultaneously, the ECB is somewhat reducing the size of its balance sheet by not reinvesting fully the amount of maturing assets from their previous purchasing programs. This is embodied in our forecast by the shadow component of the interest rate, which is steadily somewhat above the headline Euribor rate. We have seen some increase in crude oil price in the world commodity markets in recent weeks, but the current market outlook expects that crude oil price should start to decline modestly from these elevated initial levels. As for the domestic fiscal side, we expect that nominal consumption growth in government sector will significantly decelerate this year, following the fact that there is a fade-away effect of last year's extra revenues spent on assistance to Ukrainian refugees, which together with some austerity measures on the expenditure side, which relate to the consolidation package introduced by the current ruling coalition as from the beginning of this year, will lead to some expenditure cuts or even expenditure wage bill freezing in the public sector, and that's why the nominal pace of government consumption growth is approximately half of that we saw in the previous year. Fiscal impulse as a whole, taking into account all relevant fiscal measures on both revenue and expenditure side of public finance, will be significantly contractionary this year, subtracting approximately 1 percentage point or 0.9 percentage point from the expected GDP growth for this year. After this major consolidation package effects fade away, we expect broadly neutral fiscal policy in 2025. Inflation picture is quite advantageous from our point of view. Inflation dropped to just 2% during the first quarter of this year, and our current new forecast expects that the inflation, headline inflation, will be very close or in the vicinity of the 2% inflation target on the whole forecasting horizon, including monetary policy horizon, which is currently located in the second and third quarter of next year. There are only marginal effects of changes to indirect taxation to be expected over the next 18 months. That's why monetary policy inflation, which is headline inflation excluding primary effects of indirect taxation changes, is very close to headline inflation, actually being slightly below it. As I mentioned, in February and March, we saw headline inflation in year-on-year terms dropping to 2%, which was driven primarily by significant deceleration in the regulated price growth. As from this year, the second significant factor was were the declining prices in food segment, which together with steadily declining core inflation and with relatively stagnant fuel prices led to the significant drop in the annual inflation rate at the beginning of this year. For the upcoming quarter, or for the second quarter of this year, we expect some short-lived and mild increase in year-on-year inflation, which will be driven by accelerating fuel price growth, reflecting the previous increase in crude oil prices and some depreciation of the Czech currency against the US dollar. As for the further outlook, we can expect that regulated or administered price growth will be still non-negligible, despite being significantly below what we saw in previous 2 years. But from a historical perspective, it will be above average, and further deceleration cannot be expected before the beginning of next year. The contribution of food price growth will be still negative, whereas core inflation will be virtually stagnant this year with the imputed rent components making gradually more visible contribution compared to what we've seen in recent months and quarters. As for the factors from the perspective of our core projection model, we have seen that total dynamics of costs, of production costs in consumer sectors are currently close to zero in year-on-year terms, when the costs as such are growing still non-negligibly, whereas the contribution of the surcharge to costs, in other words, to the change of profit margins, has turned into negative territory, meaning that profit margins started to decline significantly from their previous peaks in both consumer and intermediate sector. This is a result of the previously very subdued domestic demand, especially private consumption, and by the fact that, the restrictive monetary policy increased the savings rate of households and eliminate the room for further price increases on the firm level. As for the costs in the consumer sector as such, we've seen some short-lived spike at the beginning of this year, which was related to the increased core import prices contribution, which related somewhat to the changes in the regulated part of electricity and gas prices for firms, whereas the energy import prices as such have been declining following the previous relatively benign developments in the world commodity markets. The intermediate goods price contribution is still significant and is driven especially by the wage in market sector component. For this particular factor, we expect some reacceleration at the beginning of this year, following the leading and coincident indicators showing that we can expect some acceleration in nominal wage growth in business sector in the first quarter of this year, as shown by, as I mentioned, by several short-term indicators. On the other hand, the labor efficiency and relatively stable contribution of price of capital will work in the opposite direction. As for the labor market as such, we have seen easing of its tightness over the last couple of quarters, and we expect that this easing will continue throughout the rest of the forecast horizon. This will be reflected also by the roughly stagnant total employment and by slightly and gradually increasing rate of unemployment, which is still one of the lowest among the EU countries. As for nominal wages, I have already mentioned that in quarter-on-quarter terms, we can expect that this growth has already accelerated in the first quarter of this year, but in year-on-year terms, this will be more visible further throughout this year, but in Q-on-Q terms, there will be no further acceleration, but rather deceleration, which will then be seen in next year when looking at the year-on-year data as well. And there is still a significant wedge in the dynamics in business sector when compared to the public sector because of austerity measures on the expenditure side in the public sector related to the consolidation package. After many quarters of relatively deep decline in a real wage, we can expect that real wage growth will turn significantly positive and will be one key factor standing behind the expected recovery in real consumption growth for this year and the next. For the GDP growth as a whole, we expect that after last year a mild decline, we can expect non-negligible recovery of the domestic economy, with GDP growing in annual terms by 1.4%, driven especially by the recovery in real household consumption growth. Next year, we can expect further acceleration of domestic economy, with GDP to be at approximately 2.7% in year-on-year terms for GDP. The data published this week from the Czech Statistical Office describing the flash estimate for the first quarter of this year were pretty or broadly in line with our expectations, showing 0.5% GDP increase in quarter-on-quarter terms and 0.4% growth in year-on-year terms. I mentioned that GDP growth will be driven primarily by expected recovery in real household consumption growth. This will be driven by the renewal of positive growth in wages and salaries in real terms, or in real growth of whole disposable income of household sector. Simultaneously, the previous very cautiously behaving household sector will somewhat change, or is gradually changing its economic mood, and this will be reflected by the expected gradual decline in the household savings rate from the previous heightened levels to towards somewhat less significant values. For the government consumption, we expect in real terms decelerating growth. Gross fixed capital formation has been benefiting from relatively steadily growing private fixed investment in the corporate sector, and the forecast does not change this picture at all. On the other hand, we can expect that previously strongly declining changes in inventories that curbed the overall investment activity in the economy will gradually fade away. And from public sector investment, we can expect a relatively mild, but in 2025, somewhat better contribution following the gradual phase-in of the new EU programming period. Both exports and imports dynamics were negatively affected by the subdued domestic and foreign demand in the recent quarters. With the expectation of recovery in both, we can expect that also trade volumes and trade dynamics will gradually accelerate and turn into a positive territory. The new forecast expects that the Czech koruna Euro-Czech exchange rate will be at 25.2 in the second quarter of this year. Then the currency will appreciate slightly and will get somewhat below 25 koruna per euro at the end of forecast horizon. This will be an outcome of two counteracting factors. On the one hand, the gradually narrowing interest rate differential between koruna and the euro area will curb the appreciation. The opposite the opposite effect will stem from the increasing current account deficit, or current account surplus, or in other terms, in increasing net exports in goods and services in current prices. Consistent with the new macroeconomic forecast is a further decline in market interest rates. The decline is initially quite steep, but is becoming less pronounced later on. Interest rates will be close to the expected policy neutral rate at the end of 2025. This will be our response to the fact that foreign significant price pressures have almost completely faded away, and domestic demand pull inflation is very, very subdued by both fiscal and monetary policy restrictive stances. Let me now briefly compare the new forecast with the previous projection we prepared for the February meeting of the board. When looking at the headline CPI inflation, you can see that the forecast has been revised somewhat downwards, which is a reflection of somewhat less pronounced dynamics in regulated price growth and somewhat milder core inflation outlook. GDP growth, on the other hand, was revised upwards, which is a reflection of both domestic and foreign demand. Which is a reflection of the somewhat better outlook for domestic demand compared to previous forecast. As for the wage growth in business sector, nominal wage growth in business sector, we revised the outlook upwards following what I have just mentioned, that the short-term indicators from the end of last year and especially from the beginning of this year are now indicating somewhat more pronounced dynamics, and the better GDP outlook is working in the same direction. Short-term exchange rate forecast is at weaker levels compared to the previous outlook, which is primarily the reflection of the observed data from the first quarter of this year. The depreciation pressures were partly related to the change in mood among major central banks around the globe when discussing about the start of the cutting interest rate cycle. But this is kind of level shift, and the pace of the expected appreciation, the steepness of this trajectory is relatively the same as it was in the previous forecast. When we look at the forecast change decomposition when it comes to the interest rate path, you can easily see that the initial state is pushing our new interest rate trajectory upwards. In this factor, there are three sub-components working in that direction. The first one is the stronger wage growth and stronger GDP growth at the beginning of this year, and weaker than expected corona in the first quarter of this year is making the contribution in the same direction. As for the foreign environment, its overall effect on the interest rate trajectory is on the upside, mainly reflecting especially higher market outlooks of the ECB interest rates compared to what we incorporated into our winter forecast. We made several expert judgments in the new forecast to better include some non-model factors into the macro story. Those are in some pushing the trajectory upwards compared to the previous forecast. The first expert judgment or adjustment is related to the acceleration of the growth of household consumption, which is in the forecast recovering somewhat more in somewhat more pronounced pace compared to what the model predict itself, because the improving sentiment is somewhat non-linear factor, which has been addressed by this expert judgment. And second, in the past, we made some adjustment to the effect of an interest rate differential on the exchange rate developments. We incorporated the expert adjustment that were curbing depreciation, and now we are partly removing this expert judgment, which is making a positive contribution to the interest rate path when compared it with the previous forecast. And the model change, which is relatively negligible contribution, is reflecting the fact that since the winter forecast, we switched from the G3 plus model in its previous version to a new version, which we call updated or facelifted G3 plus core model. Let me now turn your attention to further scenarios we prepared for discussion of the board members. And for you, this is a sensitivity scenario reflecting the exchange rate sensitivity scenario produced by the updated, facelifted G3 plus core model. This is the standard UIP, short-lived, non-fundamental shock to the initial level of the exchange rate, which is plus minus 3% away from the figure that is expected in the baseline scenario. And you can see that this scenario has been prepared a symmetrical one. In all the versions, the response of the inflation and GDP growth is relatively mild because of the endogenous monetary policy reaction and because of the fact that everyone in this simulation knows that this is just a short-lived exchange rate shock with no major fundamental factors standing behind, and all the expected trajectories are relatively untouched, and that's why the exchange rate as such and the interest rate trajectory is in both versions relatively quickly behaving back to the initial baseline scenario. For a quite significant period of time, there is a debate among central banks around the globe about potential shift in the natural rate of interest, or so-called R-star. This debate has been present in the literature and in the among practitioners already before the COVID crisis. Now the discussion is renewing again. There are several arguments mentioned in this debate that could somewhat advocate higher R-star compared to what the central banking community thought until recently. Among these factors, we can see green transformation, higher climate risk, digitalization, and further development of artificial intelligence, as well as higher defense spending in many countries. All these factors are those who increase, on the one hand, government spending, and on the other hand, leading to higher demand for investment from both public and private sector side, and this could somewhat lead to the change of the R-star parameter. Also, partial deglobalization or friendshoring or nearshoring is possibly a factor standing for prospective change in the R-star. Population aging, on the other hand, can have direct effects in both directions. When population is aging and people are creating sufficient savings to be spent after their retirement, this is decreasing the R-star, whereas if the population is old enough, I would say, then the drawing down of those savings is pushing the R-star downwards. In the Czech Republic, we have been following this debate quite closely. As you may have known, may have heard, we were quite cautious when changing our R-star considerations before COVID, but currently there are really factors that might push domestic R-star somewhat upwards, including higher fiscal deficits we have seen in the recent years, together with higher riskiness of the country as such, which has gone through a very volatile period of time, including high inflation. we can ask ourselves whether our growth model, which was based on the previous massive inflow of FDI and export orientation of our industry, has been getting exhausted over time, and whether there is some further space for real convergence and for further real equilibrium appreciation. There might be also non-negligible spillovers of potentially higher R-star from abroad. Internally, in-house, we have 3 methods available for the estimate of the R-star. The results of all the 3 methods do not challenge significantly the baseline specification of our core projection model, which has the R-star at 1%, and the implied monetary policy neutral interest rate is then 3%, 1 plus 2% inflation target. Those 3 methods were updated recently. You can see that the method based on the structural model of small open economy have been showing some upward tendency after the very significant downward spike during the COVID period, but currently its level is only marginally above 1%. Method based on filtration of long-term interest rates using 5-year interest rate swap is also showing upward tendency, but the current level is still very close to 1%. And the third estimate is our own replication of a seminal work of Holston, Laubach, and Williams, and using their structural model for Czech specific circumstances, we have come to a conclusion that there is a relatively flat R-star stemming from computation using this method. Despite that the baseline scenario is still based on the 1% R-star assumption, we prepared a simulation in which the R-star have been shifted upwards in both euro area and domestic economy, in both cases by 0.5 percentage points. Simultaneously, we somewhat recalculated the outlook for a three-month Euribor interest rate path, which for this year is virtually the same as in the baseline scenario, but when looking in more distant future, we suppose that the ECB will not cut the interest rates as deeply as the market outlook currently expects. Simultaneously, the initial monetary policy stance of the Czech National Bank is somewhat influenced by the higher policy neutral rate. That's why, and following the fact that the interest rate differential is somewhat higher beyond the horizon shown in these graphs, beyond 2025, there is a mild pressure on exchange rate depreciation, but together with the other parts of the story, this depreciation doesn't have any significant effect on CPI profile, and at the end of the day, both central banks are ending up with somewhat higher terminal interest rates at the end of 2025. Having said that, I would like to thank you for your attention by now, and I am passing the floor to our board member, Mr. Jan Procházka.
Okay, thank you very much. Thank you for it. So, ladies and gentlemen, I would like to add some and share with you some comments from the bank board perspective. As you always know, so we have a bank board meeting yesterday, and there was a full unanimity, so the voting procedure was quite easy. It was 7-0. but in fact it was not as easy, of course, but I would like to share some ideas. So we were discussing items like pent-up savings, food prices, wages, for example, in Germany, the policy of Fed and ECB, and stuff like that. But the main part of the discussion were mainly three. We spent whole time on it. The first one was, of course, price and services, so I mean inflation in services. So the main discussion in board was whether the still higher inflation in services is due to the fading of previous cost shocks and the persistent of the services, or whether they indicate that the inflation will remain high in the future. We think it's rather the former. That means that that is the heritage of a past inflation, but of course we are not sure, so we want to be extra careful. And if we put aside some imputed rentals and services, price still grow almost 3 times higher than in the period of price stability. So we are still not sure about the sources of that, and we will keep our focus on services in the upcoming monetary meetings. But it's not as dramatic issue, so which would prevent us from some gradually easing now still restrictive monetary condition. So this was the main part. The second one was also the imputed rentals and also the general real estate prices. Some data sources have indicated rather dynamic growth of real estate prices. So we mentioned that the risk of more significant acceleration in lending activities also in the statement. So Mr. Governor mentioned it yesterday in the press conference. So we expect a gradual recovery of the mortgage market from extremely low level, which is what is important. And this fact is that the market interest rates with longer maturities are significantly higher than before and during COVID-19. And the third part of the discussion was, of course, R-star, which was mentioned by Mr. Král. So I think the results, we have so many meetings, pre-meetings and meeting with experts. So the major part of the discussion was not on the board meeting. So we just discuss it like we did some final discussion. So we discussed, the main problem was double counting problem. So we discussed various estimates of a natural rate of interest as a source of some uncertainty, what was mentioned by Mr. Král in the presentation. There has been some discussion about the share of the foreign versus domestic sources of higher R-star, and it seems to me that the foreign sources were perceived as being more important in that discussion. So this is also the reason why the alternative scenario of higher R-star started with the assumption of a higher foreign R-star, which is then reflected in higher Czech R-star. So, and at the same time, we have to some degree higher foreign R-star already in the baseline now. So this was something from the board in our perspective. Thank you very much for it.
Thank you both for the presentation and for the statement from Mr. Procházka. And now it's time for you, for your questions or points to the discussion. So if you are ready, before you ask, please don't forget to activate your microphone and shortly introduce yourself. Anyone with the first question? Mr. Bureš?
Jan Bureš, Patria Finance. I have a question about the wage growth revision upwards you've mentioned, because I was kind of surprised how significantly it was revised upwards. You mentioned some indicators you have about the wage growth at the beginning of this year. Could you be maybe more specific? What kind of indicators? And secondly, maybe to Mr. Procházka, question about the sentiment on the board. There was a pretty significant revision to implied trajectory of interest rates. How you would perceive the bank board currently is comfortable with the guidance of implied interest rates that the base scenario gives to you?
I will start, and my colleague Karel Musil may add some details regarding your first question. We have been following the standard set of short-term and leading indicators when it comes to the nowcasting or backcasting the nominal wage growth in business sector, including standard monthly data from industry and construction, looking also at results of our web scraping of new job advertisement in the respective job portals. We have been using data from social insurance revenues from the state budget statistics and some further indicators, using battery of bridge models and using artificial intelligence models. We've come to with a short-term outlook, which is somewhat, not dramatically, but somewhat higher compared to the previous forecast, and which is actually meaning that in quarter-on-quarter terms, there has been some acceleration in the first quarter of this year. Yeah, that's it. Maybe Karel may add something.
Yeah, indeed, the standard set that indicates that really the wage growth in business sector might be relatively high for the first quarters. Indeed, all of these methods are really indicating that the growth might be higher, which was a bit surprising for us because the data from the end of the previous year did not indicate it, this increase, but at the same time, it also means that we will continue in analyzing this new upcoming data to really judge whether this wage growth will somehow continue by higher pace also throughout the rest of the year, or whether it's just a temporal increase at the beginning of this year.
And let me remind you of one important factor, which is standard revision process of the Czech Statistical Office regarding the data from T-2 or T-1 year. So we still do not know precisely the actual wage development in the previous 2 years.
Okay, and I understand that last time you met with Mr. Kubíček in February, I think, so he showed you such a different numbers. Of course, it could be a surprise for you, but we had meeting in March with our team. We have also some pre-meetings, and we have a discussion about scenarios and about future development. So it was not a big surprise for us, but I understand that in this month-to-month view, it could be surprising. So, and if we are comfortable now, so it's not easy, not easy to reply. So, as was mentioned, the rate trajectory has shifted to values communicating by the board in the recent months. So, when yesterday Mr. Governor also in the statement, in the press conference, said that this higher rate path that he can use, the board can use a higher rate path than the official one, but the gap has narrowed. So I think it was completely right. This sentence completely makes sense, and according to the guidance, so what was mentioned also on the press conference and also by Mrs. Kubelková yesterday in a TV show in Czech TV. So it's not easy to have some guidance. So it's the same like Fed and ECB, as they say. We are, as Mrs. Lagarde said, we are not Fed dependent. We are data driven. We are not Fed dependent. So it's quite funny because we can also say that we are not Fed or ECB dependent, but we are really huge influence by it. This is what makes this change, and I think that Peter and his team showed you the reason why we did this, and it was perfect that it also showed you this expert adjustment, because now it makes sense also for you that what was done.
Thank you for the answers, Mr. Seidler.
Jakub Seidler, Czech Banking Association. Thank you very much. I would have two questions, one for experts, just what's the assumption for ECB and Fed cut rates till year end? And for policymaker, I would like to ask if you are saying, and also Governor Michal was implying that you will be even more careful right now, does it imply that the steps in the second half of the year regarding the cuts would be more 25 basis points. And what's your assumption? I guess you do not have consensus in the board, but maybe your personal, what could be the rate at the end of the year? Thank you very much.
The updated ECB's policy outlook, derived from market outlook, is now significantly above the levels we incorporated into our winter forecast, despite some volatility and some changes, and despite various voices, various camps of voices among euro area decision makers. But we take the market outlook at face value, and you know that in our small open economy model, the effect on domestic interest rates is in the short time almost 1 by 1. And besides that, we know that even possibly more cautious than the ECB, the Fed has become in the meantime, and you know that the US economy block is not directly a part of our core projection model, but we take the Fed and the US economy developments into account by setting the initial conditions, by expert judgment, and by things like that. And we cannot ignore that the Fed is now expected to start cutting rates very late in this year, and possibly starting with one single rate cut this year, which is something which might create or might reduce the scope or the space for domestic interest rate cuts. We have started our cutting cycle back in December last year. The board delivered three further double cuts since then. And I would say that this new forecast, besides the expert judgment and besides the other relatively minor factors, has been shifted upwards also by the effect of foreign interest, by the updated foreign interest rate outlook. If something is changing for the next quarterly round, we will be incorporating the new update or the updated outlook in a standard way.
Okay, so I will continue. So Jakub, you know that I don't like the sentence like meeting by meeting approach and data dependent and stuff like that. I know that we have to do some long-term policy, but now it's such a hard time and tough time for everybody, so we have to do it like that. So most important part for me is the communication between financial markets, bank board, and also the staff. And I think now the staff and what Mr. Král showed you, and also the financial markets and also the bank board, all the views are not similar, but I think that they are quite near. And I think there is no need to change the opinion of the markets. So I think that we are compatible with it's compatible with our forecast and with our views. Thanks.
Thank you, Mr. Haverland.
Good morning, everyone. David Haverland from ING. I've got two questions. One on the forecast. Very recently, some major energy distributors have announced price cuts in gas prices and maybe later on in electricity prices, such as ČEZ by 17% since June, E.ON by 13 or 21%. I guess because of the cutoff date, it is not yet incorporated in this forecast, or then maybe to which extent. And if this would represent a risk of the inflation getting below the target in the coming months, like in summer. And for Mr. Procházka, if inflation would be below the target for a certain time, would you be fine with rather tighter monetary policy, or would it be a reason for kind of more rate cuts or faster kind of easing of the policy? And the second question is on forecast as well. So we see that the real GDP growth and in general the economic performance has been brought up and it's picking speed with time. However, we see at the same time unemployment rate increasing. So whether this relaxation in labor market is consistent with picking up of the economy, and where does it come from, whether it's increase in the labor force, or what is the story behind that? Thank you.
If I'm not mistaken, and Carol may correct me, all these announcements of natural gas and electricity price cuts from major domestic providers and distributors have been incorporated into the new forecast. That's why this is something we take into account when formulating the forecast of energy price growth related to housing. We have been working with the assumption of the ending fixations of prices of those customers who fixed them 2 years ago or 3 years ago after Bohemia Energy went belly up, and now they are those contracts are now expiring or have been expiring over a certain period of time. We've seen recently, and their prices, the providers offer them new offers with somewhat higher prices, which is going in the opposite direction to the observed decline in the prices of energies in the commodity exchange markets. But those major announcements have been taken on board. And as for GDP growth and labor market, there is certain relatively standard time lag between the response of labor market to the situation in the real economy. The so-called Okun's law is working with some time lag, and we expect that the previous relatively lengthy economic recession, despite being not as deep but mild but relatively lengthy, characterized by very bad sentiment, will have some negative bearing on hiring activity of Czech firms, and that's why the number of reported unemployed people at the branches of Minister of Labor has become higher after quite long period of time than the number of vacancies. That's why the total employment is expected to be relatively flat, and the resulting increase of the unemployment rate is a part of the story, but the increase is relatively mild and not endangering the social situation in the country as such.
There was a discussion yesterday on the board also if the inflation outlook is slightly inflationary or modestly, mildly, or it's almost balanced. So now the result is that is modestly inflationary. So this is the result. The main reason is that inflation is still at 2%, is fine. But as was mentioned, there is a growth of some components which is still elevated, mainly, of course, in services, and this is the reason why we'll be restrictive. So this is the response.
Thank you. Mr. Schindel.
Yeah, Amir Schindel, Citibank, thank you. I would like to ask on wages. You have revised up your wage forecast. In the previous forecast, there was, say, the weekly wage level was seen as something like this, undershooting its fundamental value, and there was still discussion about some future catching up process of these wages to this, let's say, more fundamental value. So how do you assess this gap after this wage outlook revision? And also I would like to ask about the public sector wage outlook, because you have accelerating wage growth in the public sector in 2025. So how does it fit the fiscal consolidation? And regarding fiscal consolidation, I would like to ask Mr. Procházka about how the board, or how to say better, if we look at the forecast, staff still envisage relatively better fiscal numbers if you look at the projected balance of the fiscal finances, but board is still relatively negative on the fiscal stance, or as I see it as a potential inflationary risk. So how does it fit together? Thank you.
The previous forecast expected that the gap or the steep drop in the real wage level compared to its long-term trend was expected to close gradually over time and not be fully closed until the end of forecast horizon. The new forecast does not change this qualitative picture despite the higher starting condition, reflecting the short near-term revision of the nominal wage growth upwards. We still keep the same story about some potential to catch up, but the catch up as such will take a longer time than 2 years. As for public sector wages, we built our 2025 forecast based on budgetary documentation which is in place or which has been approved together with the state budget law and medium-term outlook, including that which was now updated in relation to convergence program of the Ministry of Finance. We know about the political pressure or general pressure on public authorities to decrease wages and to accelerate the nominal wage growth in public sector. As from next year, we see this as a risk, and this was not directly incorporated into the baseline scenario.
Yesterday there was no discussion about fiscal policy, so we start at 9 o'clock, so it was before the result of the state budget for April, but I think that there was no surprise. And only one note about fiscal policy or about fiscal consolidation. Sorry, only one note was mentioned by one board member, which we discussed. What mentioned also Peter, the election in 25. So if there will be some pressures, and if they will be able to survive the pressure, and if this problem can occur, but there was nothing more about fiscal consolidation on the yesterday board meeting.
Thank you for the answers. Any other questions? Anyone? Mr. Schindel again.
Thank you. I would like to ask about the R-star, just to make it clear, because after yesterday's presentation of Governor Michel, I didn't understand whether the part of majority of the board perceive a higher chance that R-star is higher, because in the statement it's written part, but during the presentation I didn't simply get it, whether this is the part or majority. Thank you.
So it's a tough discussion. So we have some result. So you can see it. It was in the presentation of Mr. Král. So he showed that the result is that there is still 1% or 3%. So and it means it's in the long-term period. So then we discuss also something like terminal size, and we also discuss short-term and middle-term size in the board, of course. But as was mentioned, so there are some numbers. You can see the charts, you can see the lines, you can find your number. And I think the main problem was that some of the board members said, I would like to see the number. And some of them said, no, it's an abstract concept. I don't like it. I don't really believe in it. So I will not use it, in my opinion. So, and the result was that that it's still 1% and 3%. But now we are discussing also this cycle, and I think that this cycle we have to use also some R-star for this specific middle term size. So, and this was the discussion of the board members, and then the result is that some of the members feel it like it's higher for this kind of cycle.
Thank you. Any other questions? Okay, Mr. Schindel.
Take this opportunity. There was the FX scenario published, and Petr Krám mentioned that there is the assumption that agents in the economy assume or knows that this shock is a temporary. So if you can simply elaborate what would be the outcome of this scenario if simply agents they do not believe that this is just a temporary shock. Thank you.
That would be a different scenario, which we didn't prepare this time. In the recent or previous years, previous reports, we equipped the baseline scenario by more fundamental exchange rate scenarios. You can find the stories and quantitative dimensions of these scenarios from our previous monetary policy or inflation reports. I cannot comment more on that right now.
Anyone else? Okay, so it seems that everything else is clear. So I would like to thank you for your participation. I would like to thank to our speakers, and we are looking forward to seeing you again in August. Goodbye.